concept of stocks dates back to the 16th century. The first recorded joint stock company was the Dutch East India Company, VOC, established in 1602. Investors could buy shares and receive dividends from the profits earned by the company. This innovative idea spread, leading to the formation of stock exchanges, with the Amsterdam Stock Exchange being the first. Bonds. The history of bonds is even older, dating back to ancient times. Governments and monarchs used bonds as a way to finance wars and infrastructure projects. One of the earliest known examples is from the Italian city-states in the 12th century, which issued government bonds to fund their military campaigns. The concept evolved, and by the 17th century, countries like England began issuing government bonds to finance their national debt. Stocks and bonds in modern times. In contemporary finance, stocks and bonds remain two of the most popular investment vehicles. Stocks represent ownership in a company, allowing investors to benefit from the company's growth and profits. Bonds, on the other hand, are debt securities issued by corporations or governments, offering regular interest payments and the return of principal at maturity. An interesting real-life story. The tale of Grace Groner. Grace Groner's investment journey. Grace Groner was an unassuming woman who lived in Lake Forest, Illinois. She worked as a secretary for Abbott Laboratories for 43 years and lived a modest life. However, Grace Groner's story took a surprising turn due to her savvy investments. In 1935, Grace purchased 3 shares of Abbott Laboratories stock for $180 each. She held on to these shares for decades, reinvesting the dividends and watching the value grow. By the time of her death in 2010, her initial investment had grown to an astounding $7 million. What makes Grace Groner's story truly remarkable is not just the size of her portfolio, but her philanthropic spirit. She bequeathed her entire fortune to Lake Forest College, her alma mater, to establish the Grace Groner Foundation. This foundation provides scholarships, internships, and other opportunities for students, ensuring that her legacy continues to benefit others. Lessons from Grace Groner's story, long-term perspective. Grace's success highlights the power of long-term investing. By holding onto her stocks for decades, she allowed compounding to work its magic. Reinvestment. Reinvesting dividends can significantly boost the value of an investment over time. Modesty and philanthropy. Despite her wealth, Grace lived a simple life and focused on giving back to her community. Her story is a testament to the impact one person can have through wise investing and generosity. Investing in stocks and bonds can be one of the most effective ways to build wealth and secure your financial future. However, understanding the intricacies of these investment vehicles is essential for maximizing returns and managing risks. This article provides a comprehensive overview of stocks and bonds, offering valuable insights and practical tips to help you make informed investment decisions. Understanding stocks. Stocks, also known as equities, represent ownership shares in a company. When you buy a stock, you are purchasing a piece of that company, giving you a claim on its assets and earnings. Stocks are traded on exchanges such as the New York Stock Exchange, NYSE, or NASDAQ, where their prices fluctuate based on supply and demand, company performance, and broader economic factors. Growth potential and returns. Stocks offer significant growth potential, making them a popular choice for investors seeking capital appreciation. Historically, stocks have provided higher returns compared to other asset classes like bonds or savings accounts. This potential for high returns is due to the fact that stock prices can increase substantially over time as companies grow and generate profits. Additionally, many companies distribute a portion of their earnings to shareholders in the form of dividends, providing a regular income stream. Types of stocks. There are several types of stocks, each with its characteristics and benefits. Common stocks are the most prevalent and give shareholders voting rights at shareholder meetings, as well as the potential to receive dividends. Preferred stocks, on the other hand, typically do not offer voting rights, but have a higher claim on assets and earnings than common stocks. Preferred stockholders receive dividends before common stockholders and have a higher priority in the event of liquidation. Market volatility and risk. Investing in stocks involves a degree of risk due to market volatility. Stock prices can be highly volatile, influenced by various factors such as company performance, economic conditions, and investor sentiment. This volatility means that the value of your investment can fluctuate significantly in the short term. However, long-term investors can often ride out these fluctuations, benefiting from the overall upward trend of the stock market over time. Research and analysis. Successful stock investing requires thorough research and analysis. Fundamental analysis involves evaluating a company's financial health, including its revenue, earnings, growth potential, and competitive position. Key metrics such as the price to earnings, PE ratio, earnings per share, EPS, and dividend yield are essential in assessing a stock's value. Technical analysis, on the other hand, focuses on historical price movements and trading volumes to identify patterns and trends that can predict future price movements. Tools such as moving averages, relative strength index, RSI, and candlestick charts are commonly used in technical analysis. If you're enjoying the content so far, don't forget to give this video a thumbs up. It really helps the channel out. And if you haven't already, make sure to subscribe and hit the bell icon so you never miss an update. Understanding bonds. Bonds are debt securities issued by corporations, municipalities, or governments to raise capital. When you purchase a bond, you are essentially lending money to the issuer in exchange for periodic interest payments and the return of the principal amount at maturity. Bonds are considered a more stable and predictable investment compared to stocks, making them an attractive option for risk-averse investors or those seeking steady income. Types of bonds. There are various types of bonds, each with its characteristics and risk profiles. Government bonds, such as U.S. Treasury bonds, are considered low-risk investments, since they are backed by the full faith and credit of the issuing government. Corporate bonds issued by companies typically offer higher yields than government bonds, but come with increased risk due to the potential for corporate default. Municipal bonds are issued by state and local governments and often provide tax-exempt interest income, making them attractive to certain investors. Interest rates and yields. The primary appeal of bonds lies in their interest payments, known as coupon payments. The coupon rate is the annual interest rate paid on a bond, expressed as a percentage of the face value. This rate remains fixed for the life of the bond, providing a predictable income stream. The yield of a bond represents its return on investment and can vary based on the bond's current market price. Key yield metrics include the current yield, which is the annual interest payment divided by the bond's current price, and the yield to maturity, YTM, which considers both the interest payments and any capital gains or losses if the bond is held to maturity. Credit risk and ratings. One of the primary risks associated with bonds is credit risk, which is the risk that the issuer may default on interest payments or fail to return the principal at maturity. Investors should consider the creditworthiness of the bond issuer, which is often reflected in bond ratings provided by agencies like Moody's, Standard & Poor's, and Fitch. These ratings range from AA, highly secure, to D, in default. Higher-rated bonds typically offer lower yields, while lower-rated junk bonds offer higher yields to compensate for the increased risk. Strategies for maximizing investments. Diversification. Diversification is a fundamental strategy for managing investment risk. By spreading your investments across different asset classes, stocks, bonds, real estate, etc., and sectors, you can reduce the impact of poor performance in any single investment. Diversification helps balance the potential for high returns with the stability of more secure investments, providing a more consistent overall portfolio performance. Long-term perspective. Adopting a long-term investment perspective is crucial for maximizing returns and mitigating short-term market volatility. Historically, the stock market has shown a strong upward trend over the long term, despite periodic downturns. Long-term investors can benefit from compounding returns, where earnings are reinvested to generate additional earnings over time. This approach requires patience and discipline, allowing you to ride out market fluctuations and capitalize on long-term growth. Risk tolerance. Understanding and assessing your risk tolerance is essential for developing an investment strategy that aligns with your financial goals and comfort level. Risk tolerance varies based on factors such as age, financial situation, investment goals, and personal preferences. Younger investors with a longer time horizon may prefer stocks for their growth potential, while those nearing retirement may prioritize bonds for their stability and income. Regular monitoring and rebalancing. Regularly monitoring and rebalancing your investment portfolio ensures that it remains aligned with your goals and risk tolerance. Rebalancing involves adjusting the proportions of different assets to maintain your desired allocation. For example, if a significant increase in stock prices has shifted your portfolio's balance, you may need to sell some stocks and buy bonds to return to your original allocation. This disciplined approach helps manage risk and keeps your investment strategy on track. Investing in stocks and bonds offers a pathway to financial growth and security, but it requires knowledge, strategic planning, and disciplined execution. By understanding the fundamentals of stocks and bonds, conducting thorough research, diversifying your portfolio, maintaining a long-term perspective, and regularly monitoring and rebalancing your investments, you can maximize your returns and achieve your financial goals. Every investment carries risks, so it is crucial to make informed decisions based on your individual circumstances and objectives. With careful planning and a commitment to ongoing education, you can navigate the complexities of the investment world and